Hey, what's up guys? John here. The mainstream media sells this line that mortgage rates are really 5.25% and 5.35%. Seems like a lot of people are buying it. But the reality is that mortgage rates for most Americans are over 7%. Over 7%, which is absolutely insane. Many people say, oh, well, in the 1980s, 1970s, they were 18% or 15% or 20%. However, back then, homes were $50,000, $100,000, right? Of consumer debt was much less. Where we are right now as a society is a completely different place than where we were 30 years ago, 40 years ago. This market would fall apart at 10%. There is no doubt about it. And we're headed right there, right now. That's where we're going. Last week I did a video saying mortgage rates are heading to 7%, and I was talking about how they're at 6.375%. They picked up massively in the course of 1 week. So if you have a typical credit score of 640 to 659, that credit score is going to bring you to a 7.5% interest rate. 7.5%. If you have a credit score just under 700, 7.188%. Really, if you have great credit, 800, you're 5.635. But what part and what portion of Americans really have that type of credit? Low debt to income ratio, great borrowers, 800, 750 type credit scores? Not many. In fact, the average American has a credit score around the 699, around the 600s and low 700s. However, here in 2021, it says 714, but we're in this inflationary environment right now where credit cards are being used as defense versus inflation in paycheck to paycheck economy. What this means is that as the cost of goods and everything is getting more expensive and they don't have the money because their wages are not rising with inflation, they simply charge it and make the minimum payments. As their utilization on their credit card just continues to increase from 10% to 50% to fully 100% utilization, what does this mean? It means that they utilize the entire credit line and their credit score starts really coming down. Hence why I believe that the real credit score for most Americans is probably going to be somewhere in the mid to high 600s. Hence why I'm coming up with a credit score or a mortgage rate of about 7.2%. 7.2%. And this is exactly what they say for consumers, at least when it comes to confidence that they can handle the mounting credit card debt in the face of inflation and even living paycheck to paycheck. Watch what they do, not what they say. Faced with consumer prices rising at a clip not seen in 40 years, consumers are increasingly turning to plastic, the digital cards too, to meet everyday expenses to fill the gaps in purchasing powers that occur when prices rise faster than income. Exactly what I've said. And we're also seeing retirees, people on fixed incomes, they're getting strapped. They are getting strapped because they're on a fixed income and everything is just rising in price. Retirees with credit card debt face deliberate financial consequences. The Fed speeds up its fight against inflation. That's why I believe they're going to continue to rack up interest rates from 7.5% to 8% to 9% to 10%. I believe we're going to a 10% interest rate, and at that point, everything is going to fall. Everything. We're on a very dark path because the Fed truly believes that they have the economy in control. There's no way that this is going to end well. There's no way. It's getting more pricey for older Americans to take out loans. And in New York, for example, look at what they're doing to credit unions with people taking out consumer loans. They are now bringing consumer debt judgments from 9% to 2%. So what that means is that if you took out a consumer loan from a credit union at 9% and they agreed, we're going to lend you $100,000 at 9%. You're going to make these payments and you'll pay off this loan on X date. You agree, and they say, fine, the risk is worth the reward. We're going to lend you the money. Now the state of New York is saying, no. Now, in fact, what you have to do is you have to bring down their interest rate from 9% to 2%. 2%. Who in their right mind would want to lend out money today in this inflationary environment at 2% and then pay people to service the loans, follow up, go after judgments and collections, and go after all of this at a measly 2% interest rate? Nobody. Why would they do this when banks are lending money over 15 to 30 years at 5, 6, 7, 8%, and now they're going to be forced to lend at 2%? And so they're fighting this. They're really fighting this. But what I think is ultimately going to happen is I think we're walking into an environment where Small lenders and credit unions are going to start really getting squeezed out, and it's going to get harder and harder to be able to afford a mortgage. Look at how things have changed and how fast they have changed over 8 months. This is what's happened in 8 months. A $500,000 home price, $100,000 down, which is 20%, 30-year fixed, 2.875% rate. This is principal, interest, taxes, insurance, $2,165. $2,165. That is very affordable. And that same payment today at 7.188%, if you're a borrower with credit around the 680 to 699 range, that same payment is $3,217. $500,000 purchase price, $100K down, 30-year fixed, right? The difference is $1,000, $1,052. Now, if you factor that in with the rising cost of produce and used cars and gasoline and insurance, everything's going up, the real expense that someone would have to come out of pocket now to live a life that they could have lived 2 years ago is about an extra $1,500 to $1,800 per month, which is about $20,000 a year when the average American earns about $33,188 per year. So about 50% of their gross income, not factoring in for any taxes, 50%. This is insanity. Home prices, the monthly payments increased 48.5%. 48.5% increase. Home builder sentiment also drops for a 4th straight month as rising mortgages push housing to an inflection point. Sharply rising mortgage rates are taking their toll on the nation's home builders as already pricing new construction becomes even less affordable. Builders' confidence in the market for a new single-family home fell 2 points to 77 in April, according to the National Association of Home Builders Wells Fargo Housing Market Index. Any reading above 50 is considered positive sentiment, but the reading marks the 4th straight month of declines for the index, which stood at 83 in April of 2021. Of the index's 3 components, current sales conditions fell 2 points to 85, buyer traffic dropped 6 points to 60, and sales expectations, this is just expectations, in the next 6 months increased 3 points to 73 following a 10-point price drop in March. Despite existing low inventory, which is a really, really big statement we've all heard, housing market's not going to change because of inventory, right? Despite low existing inventory, builders report sales traffic and current sales conditions have declined to the lowest point since last summer as a sharp jump in mortgage rates and persistent supply chain disruptions continue to unsettle the housing market, right? And this is from a builder in Savannah. Now, what is going to happen here? Home builders are looking at, rising material costs, rising labor costs. We have delays with building properties, taking longer and longer, and it's getting more expensive for borrowers to actually get qualified to purchase a mortgage that would complete a sale on one of these properties. So we have to look at the risk and reward. The risk is way greater than the reward, and because of that, home builders are going to start really pulling back on this. So there's going to be less homes built, which I believe is going to really change the dynamics of the market. Right now, mortgage refinances dropped 62% year over year, 62% year over year. Now, when I'm taking all this into consideration, I think we're going to see a couple of very interesting things happen. As I've mentioned before, we're going to see the high-end market, the $500,000 to $800,000 to $900,000 homes get squeezed harder than the $200,000 and $300,000 homes. That's definite, because the price to rent is going to become likely more expensive simply because there's going to be more people that can't afford to qualify for a mortgage, thus pushing them into a rental. And if there's more people looking for rentals than there are existing rentals, what's going to happen? Prices are going to continue to rise. And if prices are continuing to rise, not just for the tenants, but also for the property owners, they're going to be more incentivized to increase them even further, which is going to be raised insurance premiums, and there's going to be more costs with utility bills that are going to be pushed to the tenant. It's going to be a bunch of problems for the housing market coming very, very soon. And we're watching this all kind of unravel very quickly. Just over the last 30 days, we've watched rates go from mid-4s for this borrower around 689 or 699 credit score to now over 7%, right? How is this going to pan out over the next year or so? I think that if you are a real estate investor, the best rentals to buy are probably going to be the ones that are going to be most affordable. I think the market that's going to get hit the hardest, as I mentioned, are going to be the high-end market, because who is going to be able to afford a property for $1 million at a 10% rate, which would probably be about a $10,000 a month mortgage payment, which would have otherwise been about a $2 million or $2.5 million property. If we head in this direction, we're going to see the high-end market get really killed. But we're also going to see big opportunities for real estate investors and for people that have been waiting to jump in the housing market. But the people that want to jump into the housing market have to really be extremely qualified. They have to have a great credit score. They have to be well positioned, and they have to have cash. Not a little bit of cash, they have to have a lot of cash. Because the more cash you have in a market where interest rates are sky high and less people are available to actually purchase these properties, the better you're going to do. And so that's what I think is ultimately going to happen. I think we're going to see these rates continue to climb from 7 to 8 to 9 to 10%. And I think these small credit unions and I think a lot of these small lending operations are going to get squeezed with additional regulation. And I think it's going to be the big banks. They're going to all talk together. They're going to set up the guidelines, and it's going to get harder and harder and harder to get a mortgage. What do you think about all this? Drop your comments below. Smash that like button. When you hit the like button, YouTube's going to share this content to educate more people about what's going on in the housing market. Subscribe here. Consider subbing to my second channel, my personal channel. It's going to become a podcast in the next 2 weeks. Also on TikTok and Instagram. I'll leave the links for everything down below. Catch you guys later.